Chapter 16 focuses on financial statement analysis. We're taking data from our financial statements to determine certain information about these companies. We're going to analyze these companies based upon these trends, these analysis, and these different types of financial ratio. In part two, we determine the average sales period of selling inventory and the average collection period to collect our receivables. When you add those two together, that's known as your operating cycle. So you add the average sales period, the length of time it takes to sell inventory, plus the collection period, the time it plans to collect the receivables. When you add those two together, that's known as your operating cycle. So the sales period was 28.67 days. It takes us about 13.67 days to collect our receivables. When you add those together, it gives us an operating cycle of 42.34 days. That's the time it takes to sell inventory and collect the actual cash from our customers. The average operating cycle of this company is about 42.34 days. All right. The next ratio focus on we call our asset turnover, our total asset turnover. What's the purpose? We're saying or asking how efficiently did we use our assets to generate sales? Again, how efficiently do we use our assets to generate sales? The total asset turnover. Okay? So with this calculation, you take your sales divided by the average total assets. Again, sales divided by the average total assets. So we took our sales, and again, whenever you see average, it always means the beginning amount of something plus the ending and divide that by 2. Again, it's always the beginning amount for something plus the ending, divide that by 2 to see what is going to be the average. So our asset turnover here is going to be 1.53. The asset turnover, again, is going to be 1.53. So we're looking at the use of assets to generate sales. So to explain this, we're saying each dollar in assets generates sales of $1.53. So again, each $1 in assets generates sales of $1.53. Okay? We'll now focus on debt management. We'll look at some different ratios that focus on debt management. Let me drink some water real quick. Give me a second. Okay. So with the debt management, we're going to look at what we call our earnings before interest expense and income taxes. It's also called, sometimes it's called net operating income. So this shows our profit before subtracting out any interest expense we have to pay and any income taxes we have to pay on our actual profit amount. So we look at the interest expense, we'll look at our stockholders' equity section, beginning balance, end balance, and our total liability. So we're now focused on debt management. Do we have the ability to take care of all of our obligations, not just current ones, as those obligations become due? Okay? It's a long formula, so write that down. It is earnings before interest expense and income taxes divided by interest expense. Again, earnings before interest expense and income taxes divided by interest expense. We focus on the amount of earnings we have available to pay the interest that has been owed to our different creditors. So again, we're focused on debt management. This was 11.5 times. So we're saying we do have sufficient earnings available to pay the amount of interest that's owed to our different creditors. So the higher the ratio, the better. It is showing that you have the ability long term to pay the amount of interest owed to your creditors. Now, if this ratio was less than 1, that's going to be inadequate. But the higher the ratio, the better. Why is that important? Well, depending upon your ability to take care of your debts, that can have an impact on the interest rate you're paying to your different creditors. Another rate for debt management is called our debt to equity ratio. We look at total liabilities divided by stockholders' equity. Total liabilities divided by stockholders' equity. We're now comparing the amount of debt a company has against their equity. So remember that debt means you are borrowing. That is money owed to another business organization. When you think about stockholders' equity, that represents financial interest. So if you are a stockholder of any company, you are part owner of that business. So when companies issue stock, they are selling interest into their business. That's part of their stockholders' equity section. Now, creditors prefer less debt and more equity because they want to make sure that you're not just borrowing money all the time to acquire assets, that you have other sources for financing to receive those assets. So liabilities are referred to as being debt financing. When you issue stocks, that's known as equity financing. Okay? So here's our ratio of debt to equity ratio, total liabilities divided by our total stockholders' equity. So our ratio is 0.48, which is pretty good. Our debt represents 48% of our total equity. So this company has almost twice as much equity as they have in liabilities. Okay? So the lower this number, the better from a protection standpoint, because again, if you have too much debt, some lenders will decide not to loan you money, or it could impact the interest rate you must pay to those different lenders. These last set of ratios focus on how profitable is a business organization. Okay? So we'll look at some ratios that focus on how profitable, again, is that business organization. So we'll look at the income statement to look at our net income, but we'll also look at the balance sheet to look at our common shares. Common shares refer to common stock. As I mentioned before, when you buy one share of stock in any company, you are known as a common share or common stock holder. So we'll look at the number of shares that were outstanding at the beginning of the year compared to the end. We'll look at the net income, the equity on the balance sheet, the dividends that were paid out to the actual stockholders, the market price per share of stock, the interest expense that we're paying, as well as our total assets. We'll use this select information to see how profitable is the Norton Corporation. Okay? So our first ratio is our gross margin percentage. Gross margin percentage. Recall that gross margin is sales minus cost of goods sold. Again, gross margin is sales minus cost of goods sold. So this shows the actual markup or the amount of profit we have available to cover our operating expenses. So once we bought the actual products, the difference between the sales price and what we pay for is called gross margin. Divide that by sales to get our gross margin percentage. Okay? So for our example, our sales total for $94,000. Cost of goods sold was $140,000. That gave us our gross margin. Our gross margin as a percentage is 71.6%, meaning that the gross margin represents about 71.6% of the sales that took place during the accounting period. That means we do have funds available to take care of the operating expenses that took place during the course of the accounting period. Okay? Now, this next one focuses on what we call the net profit margin. So now we're looking at all of the expenses, not just cost of goods sold, operating expenses, selling, admin, income tax, and interest. We're looking at all the expenses. We're now comparing our overall net income against the sales that took place during the accounting period. So net income divided by sales will give us our net profit margin. So our net income represents 10.9% of our total sales. Again, our net income represents 10.9% of our total sales that took place during the accounting period. That's known as your net profit margin percentage. Okay, a few more. Return on equity. Return on equity. Focus on the use of stockholders' equity to earn a profit. So remember, selling shares of stock is called equity financing. It is a way of earning money for the actual or receiving money for the business. We're saying, how are those funds used to earn net income for the corporation? So it's net income divided by the average stockholders' equity. So average means beginning equity plus ending, divide that by 2 to get your average stockholders' equity. So our return on equity is good. It's 25.91%. So what we're saying is that the use of equity resulted in net income. So 25.9% of our equity resulted in net income for this corporation. So again, the higher the percentage, the better. It focuses on the use of equity to earn a profit for the business. Okay? Few more ratios. These last few focus on the actual market performance. So now we think about the stock market. Okay? Earnings per share. This shows your share of the profit that was earned by that business organization. We take our net income and divide it by the average number of shares of common stock outstanding. So again, average refers to beginning plus n divided by 2. So earnings per share in this calculation is $2.42. So how do you interpret that? Well, for each share of stock you own in this company, your share of the profit is $2.42. Now that's just on paper. But for each share of stock you own in this company, your share of the profit totals $2.42. PE ratio, price earning ratios, compares the market price per share, the current market price of the share, divided by the earnings per share. So we see here that the PE ratio is 8.26 times. That means that the current market price the stock is selling for is 8.26 times higher than the earnings per share. So what this means is that that's optimistic. The higher the PE ratio, the better for those who want to invest into this business organization. Dividend payout ratio. This shows what portion is being paid out in dividends compared to earnings per share. So we're saying that on paper, we earned $2.42 a share. They paid us $2, so this is a good ratio. 82.6% would be our dividend payout ratio. This shows what portion of the earnings were paid out in dividends based upon the earnings per share calculation. Okay? This will conclude our Chapter 16 lecture on financial statement analysis. Have a good day.